So, Anthony, I missed home so much, I clicked my heels 3 times, and now I'm back.
Is this our 801st show or 108th show or our 18th show or our 81st show?
Think it's number 801, and I'll tell you this, Anthony, I missed you most of all.
I'm Anthony. Welcome to No Vacancy Live. That's my friend Glenn.
You're watching the #1 show in hospitality.
Everybody, welcome to No Vacancy Live. That is Anthony Melchiori. I, of course, am Glenn Hausman, and thank you so much for tuning in to us every single day. We're on the air in order to learn all the latest news and insights in hospitality and help empower you and your business. How are you, Anthony?
We have one of my favorite guests of all time on because he cuts through the crap and tells you what's really going on. It has a heartbeat on the industry like no other. And I'm really, really looking forward to speaking with him today.
Yeah. So let's just get right to it, right? Because, we can have some fun small talk. I could tell you a little bit more about the Spark by Hilton, where I attended yesterday, the first ever upscale economy or premium economy brand from Hilton. Go check out the video I did with Alyssa Cleese yesterday on my LinkedIn page and at novacancynews.com. But without further ado, not sure there was much ado to begin with, you got Michael Shindler of Four Corners Involvement. Hey, Mike Stengel is not back today, Dr. Producer Suzanne. But Michael, just to give you a hard time right off the bat, he's a guest good enough for show 800. You're here for 801. So what do you think about that?
Well, and as you know, I was there for 501 as well. So I just don't want to have to wait till 1101 to come back.
I know.
But 1101. Wow. That's a lot of
I can't even imagine. I can't even imagine having us do that many shows, but we will get there for sure. And I'm sure you'll be back plenty of times before 1101. Before we get into the state of hospitality and what Michael is thinking about that, I want to congratulate him first on news that broke last week that he created a strategic alliance between Four Corners Advisors, RLA Global, and Global Branded Residences. You're all going to be kind of working with each other to try to promote each other and help each other out. Congratulations.
Thanks. These are real pros. RLA is based in Budapest and Dubai.
Cool.
Global Branded Residences based in London. And we have a lot of adjacencies, a little bit of overlap, which is good. Mm-hmm. And the idea is be able to geographically provide service a little bit earlier in the game with me coming in, a little bit more depth on the brand selection and on the branded residences. And my colleague Rian is a pro at the residential side, structuring, marketing, underwriting. I certainly understand the legal underpinnings, and of course they're different here than they are everywhere else. Yeah. So it's we're looking forward to it. We had a good meeting Monday morning in person, which is rare when we're all far apart.
Yeah.
At the ISHC conference in Washington last week.
Cool.
And are really looking forward to getting this going.
And for people who don't know, ISHC is the International Society of Hospitality Consultants, I believe, a group of people that are giving a lot of support to hospitality globally.
Indeed. And
I know.
It's a great organization.
Yeah, so I wasn't sure if I was getting the vibe that Anthony wanted to speak or not just yet. So I will get things started today. Michael, we have you come on every once in a while to be the realist about what's going on out there, because we all know I'm a little bit too optimistic, right? So I would like to get a good, well-balanced view of what's going on in the world.
Wait, time out. Did you say optimistic and Glenn in the same sentence?
Yeah. You don't think I'm a little Pollyanna and optimistic about how things go?
Yes, I do.
Yeah. All right, at least on air. Off air, I'm miserable and depressed.
I call you Pollyanna.
Yeah. So, Michael, how do you see things right now when it comes to the state of hospitality and investments?
Uncertain.
Yep.
Way to commit. A lot of stuff going on. Hey, I'm now on the screen correctly. Yay! Thank you, Suzanne.
We even got the name of the company correct, so we're very proud of ourselves around here. You give us 3, 4, 20 chances, we'll get it right.
This show 9 for me. 10 if you count one when you repeated it. So I'm pretty happy about being back.
You've got to be one of our top guests of all time, I think, at this point.
Maybe in the top 5 or 6, but
This is your
I
fourth
appreciate it.
or fifth time.
Ninth.
This is your fourth or
Ninth.
fifth time being on the show.
As Mr. Rooney said, 9 times.
9 times. Oh wow.
9 times. This is my 9th
times. Yep.
visit.
So uncertainty.
Uncertainty, continuing inflation, interest rates apparently maybe not yet as high as they're going to be, but continuing to be high. Most of the economic experts suggest that we'll be sitting here until second half of 2024 before there's some movement on the interest rates in the right direction. Perversely, that seems to be, and I understand the inflationary aspect, against job reports, which are still getting higher.
Yeah. What was that? 336,000 last month, which blew estimates out by something like 150,000. Incredible.
Yeah, I think it was supposed to be about 180, and it
something like that.
335 or so.
And 90,000 in the hospitality industry.
Well, and we'll get to that in a second because that plays into the whole uncertainty. Obviously, we have a war in Ukraine, unfortunately and sadly. It continues while we've got a new war in Israel. Let me say that the atrocities committed by Hamas are unspeakable. We have major dysfunction in the United States House of Representatives, particularly, but it exists in the Senate too, which is particularly, I think, an issue with the chiefs of staff and the fact that we can't promote any generals because that requires congressional action.
Right. And that's being held up by a representative.
We don't even have an ambassador to Israel right now.
Right.
They're trying to nominate the ex-Treasury Secretary, and they won't allow him to go through. And he's
that's another issue in the Senate about some of the very arcane rules in the Senate, but everybody's using their rights and privileges. And of course, the fact is, and I was listening to some of the news yesterday, and obviously all the news shows want to be balanced. And so the Republicans are talking about, we're giving into Iran and they're making all this money on oil. And all I can think of is if they weren't making money on oil, everybody would be complaining that oil prices would be even higher because those other suppliers would be raising their prices because there's less supply. So, I think being president of the United States, regardless of which side you're on, is a totally lose-lose proposition.
Oh, yeah. Well, you start off by half the country just basically not liking you, right? And it usually just gets worse from there.
And it's even getting worse than not liking. Now we seem to be uncivil and just downright nasty to others. I
put up one video about 10 days ago that had to do with hospitality industry politics and a particular bill that's out there in a particular state. And I was not well received, even though I was trying to be an independent arbiter.
I did watch your interview with Ahoa and Ms.
That was the second one. Yeah.
And it's I appreciated the balance because they soft pedaled some stuff. I thought that at least it needed to be out there. Yep. But they're still wrong.
Well, let's get to the state of hospitality again and that sense of uncertainty. We understand what's going on internationally here. You really laid out the interest rates issue, but I want to ask a question and start with that as the point. And I've been asking a lot of executives this exact question. Everyone says interest rates are high, but what are they high compared to? The obscenely low and unrealistic interest rates that we got really accustomed to over a decade's period of time after the Great Recession? Or are we talking about interest rates historically? Because before the Great Recession, they were higher than they are sitting today, is from what I recall. So how much of it is a real issue and how much of it is it a self-imposed perception issue, in your opinion?
I think it's about 80% self-imposed perception and 20% real. However, the real is that underwriting, cap rates, and the things on which if you bought a hotel a year and a half ago, I'm using that time period, call it
roughly.
And unfortunately, 2021 was still, of course, in a post-COVID era, so all the bets were off. But if you bought a hotel at a 5% cap rate, as many people did, and now your interest rate is 7, maybe you got some bump in your, particularly if it was a leisure property, you got some bump in 21 and you got some bump in 22.
Right.
But you're still not getting the debt service coverage ratio that lenders typically require.
Could you please explain that to people that don't understand?
Yeah. When you go to borrow against your hotel, and I'm going to use simple percentages, maybe today a little unrealistic, but you're borrowing 60 to 65% of the cost of the hotel. And I'm using cost as an acquisition cost.
Right.
And 35% is coming from your own pocket, friends and family, a syndication, possibly some mezzanine financing, but that makes it more complicated. And that lender from whom you're borrowing the 65%, $100 million hotel, you're borrowing $65 million. 2 years ago, you would have gotten that loan at, call it 4.75%. And I'm sure there'll be critics that say, no, that's too high. No, that was too low, but let's use 4.75%. If you had bought it at a 5% cap rate, you have a little bit of cushion, because 5% cap rate means you are producing $5 million on that $100 million purchase. Your debt at $65 million times 4.75 is, I'm doing the arithmetic quickly in my head.
Yep.
$2.8 million, roughly, $2.7 million, roughly. And so you have a cushion there with your $5 million of earnings.
Right.
You've got a really nice cushion. That's 100 and 2.7 to 2.3. It's 170%. But if you're borrowing at 6.5% and you're borrowing that 65, now your cushion is just going down because your debt is 7.5% today, maybe a little higher. I was looking at interest rates yesterday. 4.26% on a 10-year swap. That's the base. You add the spread the lender wants, call it 3.25 to 3.5. Maybe it's a little higher today. So now you're up to more than 7.5%. So that 7.5% against your $65 million loan is $4.5 million. Now you've only got a cushion of 10% more than your debt service. Well, that cushion, that 1.1 multiple, is the debt service coverage ratio. And lenders like bigger ratios. The lenders that we're seeing today, and particularly true as the world migrates away from banks to CMBS lenders, they want 25 or 30% cushions on debt service coverage. So either what happens is you borrow less money, meaning you have to raise equity, which is typically more expensive than debt because it sits behind the debt. Or you just can't get financing. Then you're out there, maybe you don't do your acquisition. And acquisition volumes are way down in our industry.
Yeah, for those people that are listening to this, please go back and start at the beginning of the conversation of what Michael just said and really listen to what he said, because that is a class of finance and hotels. Just that the last 2-3 minutes he was speaking is really a class in really understanding financing and hotels. And that's exactly what people say all the time. Well, it's like interest rates were much higher years ago, but you weren't financing years ago. You're financing on what you're financing today, and people make that mistake. And expenses, so that cushion, their expenses are so much greater with labor and with just FF&E, and everything's more expensive, so that there's no cushion.
Yeah. Even my bagel's more expensive.
Financing.
Yeah,
Well, it makes it more expensive, but that hurts the cushion. It's sort of crazy as the interest rates go up. The ability to refinance. One of the presentations at ISHC came from CoStar because the data is impeccable, and what we saw was that hotel cap rates today are in the 9% range. Now, again, a few years ago, 9% was a perfectly fine cap rate. I mean, I started my legal career about the time that our interest rates were going up to 17, 18%. Inflation was in double digits. So compared to that, today is great.
Right. That was in the late 70s, early 80s.
Correct.
Okay.
Correct.
For our young viewers, Michael, just stop for a second. Our young viewers, explain the cap rate again. I know we do this every time, but do it again.
The cap rate is it's the capitalization rate, and that's the rate of return going into an acquisition that the property has been producing. So a 5% cap rate means that on a $100 million property, you've got $5 million effectively of EBITDA, earnings before interest, taxes, depreciation, amortization. Yep. So it's the inverse of a multiple of an EBITDA multiple. So there, in that instance, it would be 20 times EBITDA. The inverse is a 5% cap rate.
Right. That makes a whole lot of sense. So what we're seeing right now is you just laid it out. It's getting a lot harder to get projects built and over that finish line. I think that could serve as a check and balance for the industry in the sense that you've got to be really sure a project is a good project before moving forward, right? So there's a lot more scrutiny. And the other benefit of that, not to the investor, but for people who already have existing hotels, if someone's looking to build them, there'll be less competition in their neighborhood. So hopefully that'll help with some of the demand at existing hotels. Now, going back, Michael, to the CoStar numbers, STR, CoStar, we use both names
right.
in the industry. They're saying, according to a presentation I saw a couple of weeks back during the lodging conference, that demand is going to soften at the beginning of the year and then kind of come back quarter 2 and 3. That might change some of the investment environment. Are you hearing the same thing? And what are you generally thinking now about overall hospitality investment as it pertains to what I just mentioned?
Well, I totally agree with the notion that the person with the existing hotel, particularly if it's been reasonable or recently spruced up, doesn't need to have been a full renovation, but it feels relatively fresh.
Yep.
Should be happy on the one hand that supply is at lower levels than our historic levels. You think of 1.5% to 2% a year new supply across the country. Obviously, it varies in places. Right now, I think the list that I saw most recently, New York is always near the top.
Right.
Phoenix
there was like 5 years there where I felt like 90% of hotels were built in Nashville.
Right. And then Nashville has still got good supply.
Yeah.
But so the person with the existing hotel should say, all right, I'm going to capture demand. I may not capture more than my fair share of demand, but there's not going to be new supply that's going to have an absorption problem that's going to drop my occupancy for the next 2 or 3 years. That's the good news. The bad news is that there's no new supply. Obviously, some hotels, that's a net number. So there's no new hotels no new hotels coming in. Some old hotels are going to get beyond their useful lives.
Yep.
They're going to have to be converted to senior housing or residential.
Or just, when I was at Baha Mar last week, for example, in the Bahamas, they had bought, they own a property where a old Malia hotel was that they closed in 2020, determined that infrastructure is not appropriate for a 2025 beyond audience. And they're just in the process of pulling it down to create something wholly new that's more reflective of how people want to have experiences today.
Interesting. The other thing you can do in a place like Baha Mar, you always wonder about workforce housing and to convert it into dormitory type housing.
Right on the beach.
Oh, well, then no. Yeah. God forbid your employee should have a beach view.
Yeah. Hey, listen, stay tuned for my interview I did with Graham Davis. He's an amazing gentleman. You all will like that out there. But Michael, going back to this whole notion, it's interesting because we don't talk enough. We seem to, in the hospitality industry, lump everything together. We're not separating the different sides. And I don't mean antagonistic sides necessarily. I just mean there's an investment side in new properties, buying properties, and there is the operations side. And, if you go to these financial conferences, right, we usually tend to make them seem as if they're the same, but it's got a yin yang kind of relationship to both of those things, right?
I think it always does. I mean, again, the lack of new construction means that people with existing property should be reasonably pleased about that. I would note that RevPAR, although it is recovered in nominal to 2019 is still not
Right.
ahead of 2019 with inflated
Inflation.
dollars.
Mhm.
Still a little bit behind. But expenses and not operating expenses, and this is what we'll get into the labor conversation, I think, a little.
Mhm.
But property taxes are up. Insurance is through the roof in some places, so that between those fixed costs
Right.
that are not operator controlled, not owner controlled, they're just there. The fixed costs are
Hey,
going
Michael.
up faster than the rates, than
Yeah,
ADRs.
Right. I'm sorry. I've got to give myself a shameless plug because at 2 p.m. today on my No Vacancy News podcast and video page, I'm hosting a session with a couple of hoteliers, and we're going to be talking about that fixed cost thing and what you can do about that. So go ahead and register now. And if you missed it, you can still register and watch it in the past. Sorry for the shameless plug, Michael. Continue.
Hey, it's your show.
Yeah.
But I think that you know, there's so many. Yin Yang's a great description. We've been talking about the return of corporate travel, and that it's just not there yet. And I asset manage. I see that in the hotel that I asset manage. But Cindy Estes Green from Calibri Labs made a great presentation on Saturday morning, and she made an interesting point. She said large company business travel is only returned about 85 to 90% of pre-pandemic. Small to medium business travel, however, is between 120 and 125% of pre-pandemic travel. So that the feeling about business travel may not be entirely true. It's just that small business might be 2 people, whereas the large businesses could be a dozen or 15 or 30
Right.
who are running out there. And so the numbers don't, but it's not the small guys like the 3 of us sitting here who are not traveling, but it's the major
Michael,
companies.
You're totally right about that. And again, I'm just speaking anecdotally based on what I see around the country when I'm traveling. But I've been on the road every week now for 8 weeks, and I got another 4 or 5 weeks of travel this year. I think it's the most I've ever traveled in a period of time, right? So I'm sensing that, I'm feeling that, and I'm seeing a lot of the major companies out there saying, "Oh, we're not going to do this event this year. We decided not to do that event this year," and they're cutting back significantly on some of the big size conferences and meetings. I see.
Well, I just think that it was an interesting point that it's not that we haven't seen the return of business travel. We're not seeing the return of large business travel where people would go and do a meeting someplace for the board of directors, or a meeting for the senior management, or a meeting for a regional group that might ordinarily meet, and they're just not doing it. Big shows.
I don't know. Listen, I don't know the indicators. I don't remember the indicators of 2008 crash, but the sense of what I'm feeling and everybody I'm speaking to and everything I'm seeing is it feels like 2008. The uncertainty is, I've never seen uncertainty like this, even in 2008. I don't see in the next 2 or 3 years how there can be any growth in RevPAR and how there can be any growth on the bottom line of a hotel. So when people are saying, well, we're not sure there's going to be a 2% or a 3%, and I understand that, and I've seen those reports every year for 35 years. And, you know, sometimes I agree with them, sometimes I disagree with them. Again, not to blow smoke, but usually when I disagree with them, I'm right. And I just don't see how we go forward in the next 24 to 36 months and see any growth at all. That's just my opinion. When you have credit card debt and people going into their 401k at the highest levels ever, interest rates still not coming down, with the uncertainty of the election, the uncertainty in Congress, with the 2 wars, and we're not talking about the potential war that we have with other countries. I just don't see how people are going to double down and use their cash flow for meetings and say, I don't see how people aren't going to be tanking away a lot of cash flow in the next couple of years and not really sending their people to travel. That's my opinion. I can be 100% wrong. I said don't invest in Starbucks, but here we are.
Over $1 trillion in personal credit card debt out there right now. Oh, I got to change my my name over there. I don't need a vote today.
I don't think you're totally wrong. I think that you are partially wrong. And so I'm not
I
going to
hope
put a
I'm
percentage on it.
100% wrong, Michael. I
But-
hope I'm 100% wrong.
Yeah.
I think that the one thing we learned in the pandemic, and Glenn, you've said this
Yep.
many times, people want to be in front of other people. You want to spend time. You almost look forward to sitting in the meeting room while people are speaking and panels are going on.
Totally.
And so I think that two things: revenue management is so sophisticated these days,
Yep.
way more than even, gee, it's an empty seat and we lose it if it's not filled, or an empty bed and we lose it if it's not filled. I see it from filling in slow periods with small group business, and even if the rates come down, your RevPAR still is holding the levels you're looking for because you're picking up occupancy.
Right.
And that the data for a given hotel in a given hotel market is so transparent that the people that do good revenue management can pick that up, and they can flash a special immediately. The quality of the reservation services, whether it's the brand's reservation services or the third-party white label guys who have these incredibly fast capabilities. You can slap a rate up 3 nights for the price of 2. Something, you get a free breakfast, you get free parking, whatever it happens to be, to try to grab quick transient business to fill some of those holes. It's the sophistication is marvelous, and it's great for the hotel owners that utilize it, because their operators are really paying attention to those. You got 50 rooms tonight you want to fill. If you can fill 10 of them with a special, hey, that's good news. It's not like the old days. Well, it's the day we're there. It's a more expensive room. Well, maybe it shouldn't be a more expensive room.
Yeah, I can't agree with you more. The revenue strategies, and I've been in revenue management for a long time. It's they're and in the next couple of years, AI is going to just supercharge that. And in some places, they are already supercharging it. I agree with you. I just don't see growth. Maybe it's flat, but I don't see a lot of growth in the next couple of years. Hopefully I'm wrong. Listen, if you look at the markets, whether it be, and Nashville's still a strong market, there's still a lot of things going on in Nashville. But if you look at New York, we had 80,000, 90,000 rooms 10 years ago, and now we have 170, 180,000 rooms. I mean, the big hotels in New York couldn't make it before COVID.
Right. Well, the good news is Airbnb was banned, so that should throw a little bit more customers into the marketplace, right?
Right.
Yeah, Michael, I've got it. Yeah, go for it.
We looked at was that very issue that 80% of the stuff from VRBO, for example, short-term rental stuff, is 3 bedrooms and higher. So that some of those are not really competing with the hotel.
Right.
There's some studios and 1s and 2s.
Right.
But most of it is true vacation rental by owner.
Right.
So,
that's a really good point. All right, Michael, I've got a question for both you and Anthony. I've been grappling with this as well. I was talking to someone just about this yesterday. Flight costs, they're really getting expensive now. Like, no joke. I feel like they're close to double what I was paying a year ago, and certainly more than double than what I was paying in like 2019, for example. That's starting to give me pause about traveling. And a lot of the hospitality industry is closely tethered to that air travel requirement to get to people's hotels. How are you seeing that as possibly affecting occupancy and rate and all of those kinds of things in the coming year?
Well, I haven't thought about air travel costs.
Yeah, and let me, while we're
I just
doing
sort
that,
of go online. I try to compare as well as I can. Being in Chicago, I have choices of 2 different airports, and therefore just about every airline. And I try to do a little comparison, but the fact is I live close to Midway. And if I can get there on a nonstop on Southwest, almost always I do it. But Southwest is hardly a low-cost carrier anymore.
Yeah, they're not. There's no such thing as a low-cost carrier.
I flew to Washington last week on American because I compared the prices, and American was actually less expensive, even when you factor in the higher Uber cost to go to the airport. Right. It was less expensive than Southwest for the same trip. I confess I haven't given a lot of thought to travel costs. I think if you got to go, you got to go in another $50, $100, $150.
Yeah.
I can tell you this. I used to go from Phoenix, where I spend the winter, to Calgary for the hotel that I asset manage, for about $450 round trip on WestJet.
That's
I
great.
just bought a ticket for my December board meeting, which is when we go to look at and approve the budget, basically. $750.
Right. That's what I'm saying.
But I had to go.
But you got to go.
Client approved it. I'm gone. So
Yep.
it's
Well, and I think that's my point, Glenn. All these things are taking over, right? It's it's whether it's airfare, whether it's insurance, whether it's Uber, everybody's getting hit. And when you're seeing people that have disposable income cutting back, they're cutting back on takeout. They're cutting back on going out. I see my friends who have BMWs and Mercedes going to Kias. You're starting to see the tightening up of the disposable income crowd. That's what concerns me. That's what I remember seeing in 2008. And so, again, I'm optimistic. I am optimistic that we have the best revenue management. We have the best finance people. We have the best operators in the world in this business. So where there's money to be made, the money will be made. But I just think there's going to be a tightening of purse strings across the board, not only with businesses. And I think a lot of people had that revenge travel. And I think it's going to slow. And again, I'm not, hopefully I'm 100% wrong. I just don't see increase right now. I see everything flat for at least 2 years. And hopefully this time next year on our 1100 show, Michael, you can say I was wrong. No, 1101 show. Because you're not worthy of.
You're getting too much credit there, Anthony.
Well, and our friends at CoStar are projecting, I haven't done a compound average rate, but they're projecting 4.5% RevPAR growth next year, 4.1 in 25, 3.5 in 26, 3.5 in 27, 2.6 in 2028.
Well,
so on
they're
a compound basis, that's about 4.1, 4.2% a year on a compound average growth basis.
And they may be 1,000% right. They have a lot more analytics in front of them than I do. And I'm just telling you, based on my 35 years experience and everything that I look at on a daily basis in my own business, I'm starting to see warning signs of consumer spending really, really coming down.
Yeah.
And again, not now, not the second, but again, the uncertainty in the world is what's going to drive this.
Oh,
in my opinion.
And it's all over. There's no one. There's not a magic bullet to fix this problem.
No, actually, that's not true. Glenn has all the magic bullets.
So
he just doesn't share them.
Well, you know, I don't want to injure anybody over there. So
Just to keep the show going.
So right. So Doug McMillon, he's the CEO of he's president and CEO of Walmart, spoke at the Goldman Sachs' 30th annual Global Retailing Conference and said inflation and higher prices are kind of with us. We'll see disinflation, but not all the way back to deflation, certainly not in the short term. What we've seen over the last few years has resulted in groceries and consumables having a pretty big 2-year stack inflation number, and it's coming down a little bit, but not a lot. So he is saying in the end that he's concerned about how it's going to impact discretionary purchases, he says a little bit later on, even though Walmart right now isn't sensing that. But the concern with the biggest companies now are on that consumer pullback. And just like Anthony said, they're keeping a sharp eye on that.
It's hard to see. And Anthony, on that basis, I totally agree with you. It's hard to see where that's going to come from. You know, we saw this year, a softening in U.S. leisure, but not because people stopped traveling. They just started going further away.
Right.
And we have not seen any Asian inbound travel for the last several years. The Chinese are not traveling.
Right.
Their economy is, you know, I think I saw a statistic, I think yesterday, that said their economy is growing at an average rate of 6.5%. And for China, that's too slow.
Right.
So we're not seeing any of that inbound travel. The question as to how the war in Ukraine is going to affect people going to Europe, affect the war in Israel, how is that going to affect people going to the Middle East?
Right.
We'll see. Maybe some of those trips will start to come back to the U.S., but I do think people are still going to want to travel.
I agree, and I think what Michael is,
100%.
yeah, I think what Michael is saying, to recap, is in the summer of 2022 was that big summer of travel in the United States. A lot of people got into their cars, they got into airplanes, and they did a lot of these secondary locations or Florida or something like that. This past summer, they're like, we had enough of that. We're going to Europe. And a lot of people, a lot of money left the United States as opposed to staying here. And we still haven't seen that travel come back, particularly what you said, I'll say specifically from that Chinese audience. And the Japanese audience hasn't like come back either into like Hawaii, for example. So we're seeing.
I don't know the stats. I don't know the stats, but I'd imagine European travel from the U.S. this year probably was the height the biggest we've ever seen.
At least according to Facebook posts.
What's that?
Well, at least according to Facebook
you could probably look at it at air. Somebody get a guest who can look at the airline travel to Europe, and that would probably give you a hint of that kind of, what kind of occupancy they had. Do they call it occupancy on airlines? What kind of sell-through they had, whatever their term is.
Yeah, I think they do everything through seat miles or something like that.
Okay.
Yeah. All right. So, Anthony, what else you got for our friend here?
I always appreciate your insight, and thank you so much for being with us on our 101st show. We will invite you back for our 1101st show.
Listen, Michael, I'm gonna do one better. I think you should come back for 850. Let's like book it now and get you a little halfway to 900 love.
6-7 weeks from now. That's right around.
Yeah. Well, we're doing on average probably 2 to 3 shows a week. We try to do 3, but the travel schedules that we've had.
So Michael, I'm going to put you on the spot about our show. You listen to our show at all?
I listen to your show occasionally, more when I'm in Phoenix in the winter because of the time difference.
Yeah.
Okay.
Here it's 11:37, so I'm an hour behind you. It's sort of the middle of the day.
Yeah, right.
In Phoenix, when I'm in Phoenix, it's a 2-hour time difference in the wintertime. And so it's a little bit earlier.
Should we change our time to 8
No,
o'clock?
I think too much of your audience is likes this. It's sort of a lunchtime with Glenn and Anthony.
Yeah, for sure. And we have a few people that definitely say that. And I'd be curious as to if you all want to send us some feedback, because Anthony and I we've done a couple of just jump online shows at 9 a.m. and they perform really well live. Of course, our downloads remain consistent because people have a very different habit with that for audio. But I'd be curious if what you think out there, whether or not we should try to change our time or just be more flexible with it.
Michael, we have 100,000 downloads a month. If you could download every hour for 30 days, maybe we can get to 200,000.
Right. Not going to happen. But I do go back there when I don't listen live. I always know who the guests are, and therefore, when it's something that really tickles my fancy or something really directly on what I do on a daily basis, I'll go back and listen to it for a little while. I listened to Mike Stengel yesterday because I saw the notice that it was show 800. And it dawned on me of my history with you guys. And which I thought was worthy of calling out on LinkedIn. I'm sure Glenn saw that.
I did. I gave it a little heart.
I think we renamed the show "Tickle Michael's Fancy."
Yeah,
I like that. And then you can. The only thing you haven't done is when you do the what is that called? The B-roll before when you're introducing the show. Yeah, I haven't seen myself in that one yet.
We got to redo that because I still have my COVID hair, and we've been talking about redoing that opening.
I have my COVID hair too.
Yeah. Michael, before we wrap up today, how about just pulling it all together, giving us one synopsis and where you think people should be focused when they're considering investing today in the hospitality business? Maybe it's not a hotel. Maybe it's one of these tech companies that are out there. How are you seeing the overall picture?
Actually, my most recent investment is in a cannabis company. And I am not a partaker, but I love the business model.
Well, I like the business model too, as someone who's on the opposite end of that, not an investor, but a partaker. So I'm just glad that there are people like you out there.
Yeah, I like it. And I'm in a lending group and I'm now going to be in a retail group.
Cool.
So I'm excited about that. I still think I was looking at a map of one of the brands today that
Mhm.
not one of the major brands, but one of the limited service,
Mhm.
highway location
Yeah,
brands,
gotcha. Mhm.
and it has plenty of places it could go uh, quite readily. I think that the limited service hotel is still, if I was investing, that's where I would invest, or a focus service property.
Yep.
I think there are plenty of markets that could use some new hotel stock. And so I think that's where I would go if I was investing in the hotel space. I think that legislation is going to hurt, broadly speaking, like New York banning Airbnb. I think it's
Yep.
going to hurt that investment for short-term rental.
Mhm.
I think that there are some markets out there where buying single-family homes to be rented.
Mhm.
Fortunately, I recently did that in Denver, and we spruced it up a little bit and rented it almost immediately. A lot of demand. So I will tell you my biggest concern going forward. We're
Yeah.
all in budget season right now.
Mhm.
End of this month, budgets are going to start flying from hotels to owners and asset managers, and we're going to be all looking at all kinds of things. I still think that there's an enormous hangover of capital expenditures after a year and a half of not having any capital expenditures during the COVID.
Mhm.
The ability to use the capital that was in the FF&E reserves and the capital reserves for operating costs, to keep your hotel going, to keep your employees in place. I think that hangover has continued still. Nobody's got big reserves anymore because most of that money was used in 20 and 21 and maybe even into 2022. But at the same time, 20, 21, 22, 23 now, 4 years since any hotels have gone to, not any, but most hotels have gone through, whether it's a rooms reno or an F&B refresh and so on. You got to believe that the brands are going to start saying, hey, it's time for us to reinstitute capital.
Mhm.
And in a time of high interest rates, poor ability to refinance. We didn't even talk about CMBS maturities today, but those are a little nuts right now. I think that we're going to see a capital crunch. So I don't know who's going to come to the industry. Maybe it's all this dry powder. But even those guys, when they raised that money, they were expecting interest rates to be 300 to 400 basis points lower than they are right now.
Right.
And they were going to come in as heroes. Now they've got to see how they can set up their capital stack to make all that dry powder work economically.
But real quick, Glenn, before we go, how much leverage does the brands have really today on pushing that capital
Great
expenditure?
question.
I'll give you an example before I answer the question. Back in mid 2000s, Holiday Inn, IHG announced that all Holiday Inns need to be upgraded by the end of 2009, or else they're gone from the system.
Right.
They stuck
Which
to
was a
that
great help
even
to the
through
industry.
the recession, stuck
Right.
with that, reduced the size, but improved their branding.
That was over a $1 billion investment by owners in that time. And it really saved the brand and the relevancy of
But
it.
however,
I agree.
Michael, that was, in my opinion, because I talk about that a lot, because that
Mhm.
really helped transition, I
Mhm.
think, the brands, and really helped giving them the power because they saw it work. However, in my opinion, I could be 100% wrong. That was more a branding refresh for the brand as opposed to a hotel refresh.
Agreed. And but I think it's a great example of where the brand's power and the thing. I don't know if Hilton's coming out with a new HGI in the next 6 months, a new gen,
Mhm.
then all those people who are too early to really be on are going to be pushed out. I just think that that's smart business, and there's no way anyone can say that Nacetta and his team are not smart business people.
Agreed, which leads us to the final question that I have for you today. I made a little note to myself so I wouldn't forget. Conversions. I've noticed a lot of the hotel brands now are quietly shifting their strategy from this is the brand new build brand to this is the brand new conversion brand. Are you witnessing the same thing, and how do you see that play?
I mean, I'm witnessing it only through the trades and,
Yep.
trying to pay attention to what's
Mhm.
going on. I am not seeing it personally.
Mhm.
I think it makes a lot of sense because some of these buildings just can't fit a brand anymore. So that now IHG comes up with a new fully conversion brand. They've never explained why the name is what it is, and I'm sort of
Garner?
curious about that name. Yeah, kind of curious about that, but uh, I think it's a great idea. But again, it's going to require capital. You got to deflag and deassociate with whatever it was.
Mhm.
You got to put the capital in. They're going to have some physical brand standards, even though, whether it's a brand like an HGI or even
Mhm.
like a Holiday Inn Suites and a Holiday Inn Express today, they're going to have some brand standards. There's going to be life safety issues and things like that that have to be addressed. So it's still going to be a capital play, but it may be a less expensive capital play because you're buying an old
Mhm.
hotel or you're converting an older hotel that otherwise would need to be upgraded to stay in a system. And now you're
Yeah.
creating a new story. So I think it's a great idea. It'll be interesting to see how it plays out.
But
The
improving
capital
that bump,
situation.
right? Improving that bump of, or proving that bump of, okay, we're going to do the transition. This is the bump you're going to get. How many times have we seen that transition and this is the bump you're going to get and you don't get the bump? I mean, I've seen that
As often as
more
not.
times than I haven't seen it.
Yeah,
Right?
I think the brands, the brands as they grow, I mean, you started with premium economy as opposed to upscale economy. Is that a distinction, by the way? Upscale economy and premium economy?
Yeah. Well, we have this thing. It's a distinction for people like us, not for consumers.
Yeah, but I'm not sure that, that's a Hilton brand. I'm not sure that the people sitting in McLean are going to be able to articulate that distinction all that well. I mean, I wrote a blog about this when I was blogging back in the first Four Corners days for Hotels Magazine. I said, do the people in Bethesda and now McLean really understand those fine points of difference? They tell the story,
Mhm.
but I'm still trying to figure that out sometimes. When is the
Michael,
town
I am
place
shocked that you
appropriate?
don't know the difference.
Hey.
One has a croissant, one has a chocolate croissant.
Yeah. Come on, man.
Well, if you put it that way, if you
Right.
appeal to my food tastes, I'd get them all. I'd know where to go.
Seriously, I'll never forget. Like there was like 5 years where all the brands were like, "We have a cinnamon roll. Now we have a bagel."
Listen, if you ever just say, Anthony, give your opinion on all of these brands and what's going on, hit play and then shut it off in an hour, I won't have a career.
Yeah.
Well, I understand that.
Or we could just end this stream and continue our conversation. Michael, any final words?
We're all there. Let's keep at it. That's the one thing this industry does well is it keeps moving forward.
Yeah, it sure does. Thank you so much for being here. Hang out for a second if you would. Really appreciate you being here. And we really appreciate all of you sticking with us through more than 800 episodes here on No Vacancy Live. Be sure to follow us wherever you get your shows. You can download us wherever you want. And for some reason, if you can't download our catalog from there, let me know. I'm Glenn at novacancynews.com. And if you're listening to us right now, I hope you're out there getting some good exercise, or at least your dog is getting some good exercise. Why not watch us? Watch us on LinkedIn. Watch us on Facebook. Watch us on YouTube. All of those kind of great places. Woo! I'm tired. All right, Anthony, I got to go because, again, I've got a session at 2 p.m. Eastern Standard Time on my No Vacancy page. I've partnered with M3 and SIB cost reduction strategies in order to help you figure out how to lower your hotel expenses. And until then, remember, you've got one life, so blaze on and
Be kind to yourself.
see y'all tomorrow.